A 63-year-old man walks into a Walmart, not to shop, but to work. He pulls on the blue vest, straightens the name tag, and takes his place by the automatic doors, smiling at strangers who won't remember him 5 seconds later. 30 years ago, he wasn't standing here. He was a middle manager at a Fortune 500 company, sitting in meetings, managing teams, earning a pension he was told would be there when he needed it. Then the pension quietly disappeared. He had a 400 Then, 2008 cut it in half. Now his retirement account sits at around $22,000, and Social Security sends him about $1,800 a month after Medicare takes its share. This isn't a failure story. It's a timing story. Because if you think this is about bad choices or personal mistakes, it isn't. And if you're younger, if you're watching this thinking this has nothing to do with you, that's the most dangerous assumption of all. This isn't about age. It's about when you enter the game. The man greeting customers at Walmart didn't ignore the rules. He followed them. He worked, he stayed loyal, he saved what he could, and he trusted the system that was sold to him. And he still ended up here. That's the part that should make you uncomfortable. Because this isn't a rare tragedy or a Reddit horror story. It's the middle of the distribution. It's what happens when the rules change while you're already playing, and nobody tells you until it's too late. What makes this story unsettling isn't how extreme it is, it's how ordinary it is. According to Federal Reserve data, nearly half of Americans between the ages of 55 and 64 have nothing saved for retirement. Zero. And for those who did manage to save, the median balance sits right around $22,000. Under the 4% rule, that generates roughly $700 a month. Add Social Security, subtract healthcare, rent, food, and utilities, and you're left trying to survive on about $2,300 a month in an economy where a one-bedroom apartment in most US cities already costs more than that. This isn't about outliers at the bottom. This is the statistical center of the American retirement experience, and that's why blaming individuals misses the point. You can't explain numbers like this by saying millions of people were irresponsible in exactly the same way. What you're looking at isn't a collection of bad decisions. It's a pattern, a system producing a predictable outcome. And once you see it that way, the question stops being, what did they do wrong? And becomes something much harder to ignore. What kind of system produces this result by default? Because if the median outcome looks like quiet financial anxiety at 63, then the problem isn't behavior. It's the structure underneath it. And that structure didn't appear overnight. It was built piece by piece, long before anyone realized they were standing on it. For most of the 20th century, the retirement story was simple, almost boring. You worked for one company, you stayed loyal, and in return, you got two promises: a pension from your employer and Social Security from the government. When your working years were over, your income didn't suddenly drop to zero. It continued, quietly, predictably. That was the rulebook. Boomers grew up watching their parents follow. And for a while, it worked. But the cracks showed early, long before anyone talked about 400 wonks. In 1963, when Studebaker shut down a factory in Indiana, thousands of workers saw their pensions vanish overnight. Decades of labor, gone with a press release. That was the moment the promise stopped being guaranteed and started being conditional. Corporations noticed something important after that. Pensions were expensive. They sat on balance sheets as liabilities. They required long-term funding, conservative assumptions, and accountability if markets moved the wrong way or people lived longer than expected. So when a small line in the tax code quietly allowed employees to defer income into individual accounts, companies saw an exit. The 401k wasn't designed to replace pensions, but it was cheaper, cleaner, and far more convenient for employers. The risk didn't disappear, it just moved. It shifted from corporations with legal teams and balance sheets to individuals with no training, no tools, and no margin for error. And the most important part is this. When that shift happened, almost no one framed it as a loss. It was sold as flexibility, as ownership, as progress. But once the rules changed, the outcome changed with them, even if the players kept doing exactly what they were told. Boomers didn't step into this new system with confidence. They stepped into it at the worst possible moment. From 1966 to 1982, the US stock market went essentially nowhere after inflation. 16 years of stagnation. If you invested at the start of that period and did everything right, you didn't build wealth. You watched it erode. In 1979, Businessweek ran a now famous cover declaring the death of equities. The message was clear. Stocks weren't a path to security. They were a gamble that no longer paid off. That was the first lesson an entire generation learned about investing. And first lessons stick. Imagine being in your early 20s, hearing older coworkers talk about the Great Depression, finally deciding to invest anyway, and then spending the next decade and a half watching your purchasing power slowly bleed away. That doesn't teach discipline. It teaches distrust. So most people did what seemed rational at the time. They stayed conservative. They waited. They told themselves they'd start later when things felt safer. But markets don't pause while confidence catches up. When growth finally returned in the early 1980 seconds, something else was already gone. Time. The compounding years you can't replace. This wasn't procrastination. It was conditioning. The system trained them to be cautious, then punished them for it later. And by the time the message flipped from stocks are dead to stocks always go up, boomers were no longer at the starting line. They were already running behind, trying to make up for years they never had a fair chance to use. When the market finally woke up in the early 1980 seconds, it didn't just recover, it exploded. From 1982 to 2000, stocks went on one of the longest bull runs in US history. The Dow climbed from under 800 to over 11,000. Investing stopped looking risky and started looking inevitable. CNBC launched, mutual fund commercials flooded television, stories of ordinary people becoming 401 millionaires became proof that the system worked if you just stayed in long enough. For boomers, this felt like redemption. They were behind, yes, but now there was a way to catch up. So they leaned in. They increased contributions. They took more risk. Tech stocks, growth funds, anything that promised speed. This was the moment they finally trusted the game. And that's what makes what came next so brutal. In March of 2000, the dot-com bubble burst. The Nasdaq lost nearly 80% of its value. The Dow fell more than a third. A boomer in their mid-50 seconds with $300,000 in a 401 didn't feel a paper loss. They felt time evaporate. And just as the market clawed its way back by 2007, just as confidence returned again, the board flipped a second time. 2008 wasn't a correction. It was a collapse. Housing imploded. Stocks were cut in half. Unemployment spiked. This time, there was no runway left. The oldest boomers were at retirement age. They couldn't wait another decade for recovery. They had to start withdrawing right as balances were at their lowest. This is what's called sequence of returns risk, and it's the quiet killer of retirement plans. Bad returns at the wrong moment do more damage than decades of good ones can fix. Effort didn't fail them. Discipline didn't fail them. Timing did. And once you're forced to sell at the bottom to survive, the math never really recovers. By the time the damage was done, there were no clean exits left. A lot of boomers didn't retire because they wanted to. They retired because their corporate jobs quietly disappeared, and no one was eager to hire a 60-something with decades of experience and a higher salary history. Age discrimination is illegal on paper, but in practice, it's invisible and routine. So they did what was available. They drove for Uber. They took shifts at Home Depot. They put on Walmart vests, not because they loved working, but because the math left them no choice. Since the mid-1980 seconds, the share of Americans over 65 still working has doubled. And this isn't a cultural shift toward purpose or hustle. It's financial necessity. Social Security averages around $1,800 a month. Medicare doesn't cover everything. Rent alone eats most of that in many states. This is what happens when retirement turns into a cash flow problem instead of a life phase. And here's the part that gets misunderstood. These people didn't suddenly become reckless in their 60 seconds. The outcome was locked in long before that, shaped by decisions and market timing they had no control over. When you see a retiree stocking shelves, you're not looking at a failure of character. You're looking at the long shadow of a system that transferred risk downward and called it opportunity. The uncomfortable truth is that none of this was accidental. It wasn't the result of bad luck stacked on top of bad behavior. It was the predictable outcome of incentives, doing exactly what incentives always do. In the 1,970 seconds, Congress passed ERISA, a law meant to protect workers' pensions by forcing companies to fund them more responsibly. On paper, it sounded like progress. In reality, it made pensions more expensive, more regulated, and harder to maintain. Corporations responded the only way they ever do. They optimized. They looked for a cheaper structure, and they found it in the 401. The law designed to protect retirement ended up accelerating the thing that killed it. That's not a conspiracy. That's economics. Companies don't exist to guarantee dignity in old age. They exist to reduce costs and maximize profit. Pensions were a liability. 401ks were clean, predictable, and most importantly, optional. Match a few percent, shift the risk, and move on. What gets lost in this conversation is that the 401 was never meant to carry the entire weight of retirement. Even Ted Benna, the man who popularized it, has said publicly that it was designed as a supplement, not a replacement. But once the incentives lined up, there was no going back. The system didn't break. It evolved exactly as it was rewarded to evolve. And boomers were the first generation to live with the consequences of that evolution. They didn't misread the system, they trusted it before anyone understood what it really was. If this still feels like a boomer problem, that's understandable. Distance creates comfort. It's easier to watch this as history than as a warning. But here's the part that matters most. The system that failed them is the same system you're in right now. Same 400 wongs, same market dependency, same assumption that long-term averages will save you as long as you're patient and disciplined. The only real difference is the calendar. Boomers entered this game at the wrong time. You entered earlier. That's it. The rules haven't changed, the incentives haven't changed, the risks haven't changed. If the market cooperates for the next 30 years, the story looks fine. If it doesn't, if there's a decade of stagnation or a major crash right as you approach retirement, the math turns ugly fast. And no one will call it a failure of the system. They'll call it bad luck. That's what makes this dangerous. A system that works most of the time still ruins lives when timing turns against you. And the scariest part isn't that this happened once. It's that nothing meaningful has been redesigned to prevent it from happening again. What actually matters now isn't panic or cynicism. It's clarity. If this story teaches anything, it's that a retirement plan that only works when everything goes right isn't a plan, it's a bet. If your future depends entirely on market timing you don't control, you're not investing, you're hoping. The people who are doing okay today aren't the ones who guessed the market perfectly. They're the ones who spread their risk. They owned real assets. They built businesses. They kept skills that produced income even when markets didn't cooperate. And just as important, they didn't postpone their entire lives for a finish line that kept moving. Boomers were told to sacrifice now and enjoy later. Many of them never got the later. That's the quiet tragedy underneath all of this. Build wealth, yes. Invest, absolutely. But don't design your life around a system that doesn't care when you need it to work. The man standing at the doors of Walmart isn't there because he failed. He's there because the board flipped at the wrong moment and the rules didn't bend for him. That board will flip again. It always does. The only real question is whether you recognize that now, while there's still time to plan for it, or whether you assume you'll be the exception right up until the day you realize you weren't.